Good afternoon. My name's Joe Terrell, president of Terrell & Company, private wealth managers headquartered in St. Louis, Missouri. Today is Friday afternoon, April 23rd, and this is another update on our outlook for the markets. We are very positive on the world economy. We see a very strong recovery as the COVID virus moves into the rearview mirror. We think growth in the United States for the next 12 months will average somewhere around 6.5% to 7%, and growth around the world will maybe average something close to 5.5%, 6%, which is including third world countries, etc., that tend to bring that average down a little bit. We are seeing evidence of this, with the exception being Europe is a little slow. They're still getting COVID cases under control there. They're making gains, they're accelerating, but as they can get COVID in their rear view mirror, the rate of acceleration will pick up. In India and Brazil, still a lot of issues, but we believe they will eventually get behind this and they will begin to contribute to world economic growth. So, very positive on that aspect of it. What the real purpose of wanting to talk about in today's update is inflation. The amount of money that is printed and distributed around the world is staggering. What we are doing in the United States of PPP loans and stimulus checks, the amount of money that's been given to businesses, given to individuals, etc., the amount of money that the Federal Reserve Bank is printing to buy our own government bonds so they can keep the long-term interest rate down and keep borrowing costs very affordable. This conversation is not debating about whether that is necessary or not. This conversation is simply to point out that that type of money printing, which now totals something in $6 trillion, is going to create higher inflation. We argue it's already doing it right now. It's not reflected in investment prices, and we're very concerned about when our investment prices going to have to recalculate to take into account that we have much higher rates of inflation, and because of that, our Federal Reserve Bank that has promised us they will not raise interest rates for 3 more years, and that they don't believe inflation is going to go much beyond 2% on a sustained basis. Terrell & Company, and our belief is they're absolutely wrong, and inflation is going to accelerate, and the velocity of inflation is going to pick up, and they will not be able to hold to that pledge. They'll be forced to raise interest rates sooner than certainly what they're saying. Ultimately, this will get reflected in much lower prices for both fixed income and equities. If someone out there is saying, oh, we completely disagree with you, that sounds way out of the question, I want to call to your attention that just 48 hours ago, the Central Bank of Canada came out with their announcement saying exactly this. In Canada, they're going to back off the amount of quantitative easing they're doing, and they also are moving up 1 full year to early next year when they believe they'll start increasing interest rates, and they gave a reason for it. Extremely concerned about what's happening with inflation. So we're not ready to sell everything right now and run for the hills. That's not necessary, but this is an issue that we've been talking about for 3 or 4 months, 5 months, 6 months, whatever the case has been, and it's becoming a bigger and bigger issue day by day. So we are very concerned about it. With that said, there are really two markets out there in stocks. There's the market for high-tech glamour technology. We want to be on record with everyone saying right now that market is so grossly overpriced. It's just almost unbelievable to a veteran that people would pay the kind of prices they are for some of these issues. That's an accident waiting to happen. The market for what are called SPACs, special acquisition companies, they're basically blind pools of money that people have speculated on. Those also are an accident waiting to happen. The cryptocurrencies that everyone is speculating so much on is an accident waiting to happen. However, basic industrial stocks that are very tied to the economy, things like mining companies and steel stocks, to a certain extent pharmaceutical stocks, are very modestly priced, paying very nice dividends. So we just want to distinguish that there's a lot of speculation out there that we see ending very badly. A person needs to stay away from that and stay with very basic industry. In fixed income, your average duration needs to be incredibly short. Going out and buying any type of long duration now, because you can get 2.25%, with inflation running at 3.5%, 3.75% on its way to perhaps 5%, that'll end very badly in the fixed income market for those that are not paying attention. Fixed income so far in 2021 already has had a pretty sharp correction as interest rates have on the long end come back up a little bit. So we just wanted to get a message out there to all of our clients as well as people that follow us on these podcasts that we're becoming more and more alarmed about inflation and the potential that that could have and will have in affecting our economy and affecting the prices of investments. So we will be back in 3 to 4 weeks with another update, and thank you for joining us today.